Dreaming of owning a home? It's a significant milestone, but the journey often comes with a hefty companion, your home loan. Today, we're going to unlock the secrets to saving lakhs on your home loan, transforming that dream into a financially savvy reality. This isn't just about paying less. It's about gaining financial freedom and building a secure future. We'll be covering a comprehensive guide, packed with actionable strategies you can implement right away. Get ready to supercharge your savings and take control of your home loan. For many, homeownership is a cherished dream, a symbol of stability and success. But let's be real, the path to owning your own home often involves taking on a significant amount of debt in the form of a home loan. While exciting, this also means committing to years, sometimes decades, of repayments. This commitment can feel overwhelming, especially when you consider the sheer amount of interest you'll end up paying over the loan's lifetime. It's crucial to acknowledge this reality, not to discourage you, but to empower you with the knowledge to navigate it successfully. A home loan isn't just a financial product, it's a huge emotional commitment. It represents your sanctuary, your family's future, and a significant portion of your financial well-being. The stress of high EMIs or unforeseen financial burdens can take a toll. Understanding the emotional and financial weight of this loan is the first step towards managing it effectively. When you proactively manage your loan, you're not just saving money, you're buying peace of mind and securing your financial future. Beyond the advertised interest rate, home loans often come with a slew of hidden costs that can quietly add up, eroding your savings. We're talking about processing fees, administrative charges, legal fees, valuation charges, insurance premiums, and even pre-closure penalties if you're not careful. These seemingly small charges can collectively inflate your overall loan cost by lakhs. It's vital to read the fine print, ask questions, and get a clear breakdown of all potential costs before signing on the dotted line. Being aware of these hidden expenses is the first step in avoiding them and truly saving money. Most of us focus solely on the EMI, or equated monthly installment, when considering a home loan. While important, the EMI is just one piece of the puzzle. To truly save money, you need to understand the underlying mechanics of your loan, how interest is calculated, the loan tenure, and how prepayments can impact both. Think of your EMI as the tip of the iceberg. What lies beneath is what truly determines your total cost. A deeper understanding empowers you to make informed decisions and strategize for significant savings. Interest rates are the lifeblood of your home loan, dictating how much extra you'll pay. Understanding the difference between fixed and floating rates is crucial. Fixed rates offer stability, meaning your EMI remains constant, regardless of market fluctuations. This provides predictability, but might mean missing out on lower rates if the market drops. Floating rates, on the other hand, change with market conditions. While they can lead to lower EMIs during favorable times, they also carry the risk of increasing if rates go up. Your choice depends on your risk tolerance and market outlook. Carefully evaluate both to make the best decision for your financial health. Compounding interest is a powerful force. While it works in your favor with investments, it can be a significant drain with loans. Over a 20 or 30-year home loan, the initial interest component of your EMI is much higher than the principal. This means that for a long time, you're primarily paying off the interest. This is where the power of compounding comes into play. The interest charges on your loan are calculated on the outstanding principal, which slowly decreases over time. Understanding this dynamic is key to realizing why early prepayments are so effective in reducing your overall interest burden. Now, let's talk about the most effective weapon in your arsenal against home loan interest: prepayment. This is where you actively reduce your outstanding principal, directly impacting the interest you pay. By prepaying, you're essentially telling the bank, "I want to owe you less, sooner." Every rupee you prepay goes directly towards reducing your principal, which in turn reduces the interest calculated on that amount. It's like going on an interest-slaying mission, and the rewards are significant. We'll explore two powerful prepayment strategies that can save you lakhs. Partial prepayments are your secret weapon for accelerated loan closure. Even small, consistent prepayments can have a massive impact over time. Think of it as chipping away at a mountain. Each chip, no matter how small, brings you closer to the summit. For instance, if you pay just one extra EMI per year, you could significantly reduce your loan tenure and save lakhs in interest. The key is consistency. Make it a habit to allocate any extra funds towards your home loan principal. The earlier you start, the more impact these prepayments will have due to the power of compounding. Did you receive a bonus at work? A tax refund? An unexpected inheritance? Don't splurge at all. This is your golden opportunity to make a significant dent in your home loan. Utilizing these windfalls for accelerated loan closure can dramatically cut down your loan tenure and save you a fortune in interest. It's about being financially disciplined and prioritizing your long-term goals. Imagine knocking years off your loan simply by channeling these extra funds wisely. It's a powerful strategy that many overlook, but it can be a game changer for your financial freedom. Sometimes, the best way to save on your home loan isn't through prepayments, but by switching lenders. This is where a balance transfer comes in. A home loan balance transfer involves moving your outstanding home loan from your current bank to a new bank, ideally one offering a lower interest rate. Think of it as refinancing your loan to get a better deal. This strategy can be incredibly powerful, especially in a competitive market where new lenders are vying for your business. It's not just about a lower EMI, it's about reducing your overall interest burden significantly. So how do you know if a balance transfer is right for you? Keep an eye out for a few key signs. Firstly, if prevailing interest rates are significantly lower than what you're currently paying. Secondly, if your credit score has improved since you took out the original loan, you might qualify for better rates. Thirdly, if your current lender is unresponsive to your request for a rate reduction, it's time to explore other options. Finally, calculate the total savings. Consider the new interest rate, processing fees, and any other charges associated with the transfer. If the net savings are substantial, a balance transfer is definitely worth considering. The process of transferring your home loan might seem daunting, but it's relatively straightforward. First, you'll need to apply for a balance transfer with the new bank. They'll assess your eligibility and creditworthiness. Once approved, you'll sign the necessary paperwork, and the new bank will disperse the outstanding loan amount to your old bank. Your old loan will be closed, and your new loan will commence with the new, lower interest rate. Remember to gather all necessary documents, including your original loan agreement, KYC documents, and property papers, to ensure a smooth transition. It's an investment of time that can yield significant financial returns. Before you jump ship to a new lender, don't underestimate the power of negotiation with your existing bank. Banks want to retain good customers, and sometimes simply asking for a better deal can work wonders. Many borrowers shy away from this, fearing rejection, but a polite and well-reasoned request can lead to significant savings. Remember, you're a valuable customer, and your bank would rather retain you than lose you to a competitor. It costs them less to keep you happy than to acquire a new customer. The best time to negotiate is when you have a good credit score, a consistent repayment history, and when interest rates in the market have generally fallen. Approach your bank with confidence, armed with information about competitive rates offered by other lenders. Clearly state your case, highlighting your loyalty and excellent repayment record. Be prepared to discuss your financial situation and how a lower rate would benefit you. Sometimes, a simple phone call or a visit to your branch can initiate the negotiation process. Persistence and a clear understanding of your value as a customer are key. Here's a strategic move. If your existing lender isn't budging, subtly hint at a balance transfer. Inform them that you've been exploring options with other banks that are offering more attractive rates. This can often light a fire under them, prompting them to reevaluate your request. The key is to do this strategically, not aggressively. You're not threatening, but rather presenting them with a clear choice. Either match the competitive offer or risk losing your business. This tactic can be surprisingly effective in securing a better interest rate and saving you lakhs. One of the most overlooked aspects of home loan savings comes from an unexpected source: tax benefits. The Indian government offers significant deductions on home loan interest and principal repayment under various sections of the Income Tax Act. These deductions effectively reduce your taxable income, leading to lower tax outgo and putting more money back in your pocket. Think of it as a government-backed savings plan designed to encourage homeownership. Understanding and utilizing these benefits is crucial for maximizing your overall savings. Under Section 24B of the Income Tax Act, you can claim a deduction for the interest paid on your home loan. For a self-occupied property, you can claim up to 2 lakh rupees per financial year. For a rented property, there's no upper limit on the interest deduction. This deduction directly reduces your taxable income, leading to substantial tax savings. Keep accurate records of your interest payments to claim this benefit effectively. It's a powerful tool to reduce your tax burden and, indirectly, the overall cost of your home loan. Section 80C is another golden egg for home loan borrowers. Under this section, the principal amount repaid on your home loan is eligible for a deduction, up to a maximum of 1.5 lakh rupees per financial year. This deduction falls under the broader umbrella of 80C, which includes other eligible investments like provident fund contributions, life insurance premiums, and ELSS mutual funds. Maximizing your ADC deductions is a smart financial move that not only saves you tax, but also helps you pay off your home loan faster. Consult with a tax advisor to ensure you're claiming all eligible deductions. We've covered a lot of ground today, from understanding the nuances of your home loan to implementing powerful strategies for saving lakhs. Your journey to a debt-free home is within reach, and it starts with informed decisions and proactive management. Remember, a home loan doesn't have to be a lifelong burden. By applying these strategies, you're not just reducing your financial outflow, you're building financial resilience and accelerating your path to complete homeownership. This isn't just about money, it's about peace of mind and securing your future. Let's quickly recap the key strategies we've discussed. Strategic prepayments to cut down principal and interest, considering a balance transfer for better rates, and leveraging government-backed tax benefits to reduce your taxable income. Each of these strategies, when implemented thoughtfully, can collectively save you lakhs over the life of your home loan. The power lies in consistency and a proactive approach. Don't wait for your loan to control you. Take charge of your loan and your financial future. Ultimately, the goal isn't just to pay off your home loan, it's to achieve financial freedom. Imagine a life without the burden of monthly EMIs, where your hard-earned money can be channeled towards other dreams, investments, travel, education, or simply enjoying life. By implementing these strategies, you're not just buying a house, you're investing in your peace of mind and securing a financially stable future for yourself and your family. Start today, be consistent, and watch your dream of a debt-free home become a reality. Thank you for watching, and here's to your financial success.